Great. Um, so thank you again for joining. A tiny bit of housekeeping at the beginning of the session. If you have any questions throughout the duration of the session, please feel free to put questions in the question box and I'd be more than happy to answer them at the end. I'm expecting to show functionality for about 20 minutes, potentially 25. So that does leave us with time at the end to run through any questions that are submitted throughout the duration of the session. As it says in the title, today we're looking at how much profit are you actually making. And so we're going to be looking at the Bevica solution and how we're able to track and account for various costs that are associated within your supply chain, from purchasing your product, importing your product, warehousing your product, and fulfilling it to your end customer so that you have a true understanding of the profitability achieved through each of your sales. Now, as a headline point, I'm sure I don't need to reiterate, but typically speaking, drinks are quite a low margin product, and it is a tricky product to ship when you factor in that it is alcoholic, it is a liquid, it comes in glass packaging, and there are a lot of things that make it costly to move around. And so what we really see as true value in Bevica is the ability to account for those costs from the beginning of your supply chain journey through to that end customer. So what I'm going to do in a moment is I'm going to share my screen and I'm going to talk through some of the high-level features that you can expect when working with Bevica that will allow you to have greater visibility over exactly what your costs are. And when looking at your sales, you're able to determine the actual profitability of those transactions. So for those of you who haven't actually seen Bevica, this is Bevica. So you'll see here we've logged into our kind of primary role center. So this is the screen that users see when they initially log in. Now, I'm not going to get too stuck into sort of base standard Bevica today. I really do want to focus on the profitability. And as I mentioned, if you do have questions or if there are points that come up, please feel free to put them in the question box and I'd be more than happy to answer them as we move forward. So the first thing we want to start at is just looking at an item. So within Bevica, we have the concept of products, and this for us is something where we're able to not only keep track of the kind of technical and marketing information, but we also keep track of a lot of the financial information associated with items as well. Now, typically speaking, with alcohol, there is a duty component that is associated with that product. And so for us in Bevica, we have the option to really drill down into that duty calculation. So you can see here on my example of this Barolo, I have that this item is duty controlled. I have the alcohol percentage, the unit volume, and I also have a duty code. And so based on that, we're able to calculate the duty liability or the duty tax that's applicable to this specific product. And of course, wines can be purchased in bond, and therefore the taxes aren't due until the stock is actually dispatched. But the system, being aware of those costs, can understand the potential liability either side of the transaction. Scrolling down the page a little bit further, we have some costs and posting information down here. Now, again, trying to keep this very high level and relevant, but there is a costing method that works very well within Bevica, and that's on a FIFO basis, so first in, first out. Typically, we expect, and the standard would be, that duty paid stock is consumed first, and then we would look to take the oldest of the in-bond stock that's left to be available. Here we also have a couple of cost fields sitting on the item card. Now, these are averages that are taken from the item ledgers, and I'll come on to item ledgers in a little bit, but the idea being is that at a glance on an item card, you can see a rough duty paid unit cost and a duty free unit cost for your product. Now, before we get into the purchase side, it is worth clarifying that to be able to calculate your profit, you need to understand what you're selling the price, you're selling the goods to the customer at, and what you're purchasing the price, purchasing the goods for. So within Bevica, you have the ability to be able to manage and maintain these prices in a centralized location. So we have customer price lists. We also have purchase price lists. So within the customer sales price lists, we have the flexibility of kind of setting up very, very comprehensive pricing structures, which can accommodate a multitude of transaction and customer types. As a quick summary, we have an all customer price. We have customer price groups. So if you were to set up a price group for potentially the on-trade versus the off-trade, potentially private clients, each of those customer price groups can have a bespoke price. We can then get granular and start saying we have a customer specific price. And there are ways that we can even get more granular by introducing things such as campaign pricing. And the way to think of campaign pricing is that a campaign is a sort of an activity that runs for a duration of time, and within that time frame you're able to say we want to promote this product at this price. So really great use cases for this are things like summer promotions. When you're selling rosé, you might have a rosé offer, you know, in the summer months, and say between these dates we want to offer an incentive to purchase our rosé. Equally, on Primeur campaigns, setting up campaign pricing can be a great way of managing your Primeur offers, and knowing that the system understands that, you know, when the campaign's expired, you will typically default back to a list price. As I mentioned as well, or alluded to earlier, this concept also exists on the purchase side. So when you're given your purchase prices from your suppliers, typically at the beginning of the year or at the change of vintage, you're able to input those into the system so that when you create purchase orders in the system, it automatically knows which price to apply. And with the purchase prices, in the same way for the customer prices, there is the ability to put some sort of clever logic in the structuring. So for example, if you were looking at volume discounts, potentially when you order from a supplier, they might offer you a price of €5 per bottle if you purchase a pallet. Potentially if you purchase 2 pallets, it goes down to $4.75. So you can actually set those pricing thresholds up in the solution to be able to ensure that the purchase documents that you're creating have the correct cost price of the wine, or the purchase price of the product. So I'll open up a purchase order now and show you sort of what we're expecting to see on the purchase side, because truly margin does start, or the margin calculations do start at the point of purchase. So as an example, I'm opening up a purchase order here. If I scroll down on the purchase order, I can see my purchase order lines. So this is where I'm outlining and I'm effectively stating what the item is, the quantity that I'm purchasing, and I also have the ability here to determine the unit cost per case, or per unit of measure. So as you can see in my example, this is a pretty substantial purchase order. And so this is again where we capture that initial commitment to buy stock from the supplier at an agreed price. Now, if I take a step back and look at the purchase order screens for a second, in here you'll see there's a variety of purchase orders, and we have an understanding that each of these have pure product costs. But when you think about profitability, you actually have other costs that you need to think about as well. So it's things like your freight, it's things like your insurance on your freight, it's your receiving, handling, and delivery, so your RH&D charges. People also look at things like rent costs. All of these charges, all of these costs actually impact how much your product costs you to when you actually think about receiving it. So what we have is an extension within Bevica, which is called the Distribution Cost Management extension. And what that allows us to do is capture those charges and factor them in various points along the supply chain. So if I take you to distribution costs setup, just as an example, what you can see here is the ability to add default additional charges. So in the screen, you can see I've got options against items, vendors, customers, country of origin, locations, shipping agents, and item additional charge codes. So the way to think about this is, if you, for example, knew that if you were shipping with, you know, for example, a shipping agent, and you knew that there was a €300 charge for a pallet, you would be able to set the system up so that when you place a purchase order and you nominate the shipping agent on that purchase order, that €300 charge is distributed, the cost of that is distributed against each of the component items on the purchase order. So what that will do is, when you receipt the goods, it does actually inflate your stock, because it inflates the cost of that stock, because it gives you that understanding of the costs that you incurred to be able to get that stock into your warehouse, into your bond. So if I just jump back to my purchase order for a second, I can show you some examples on the right-hand side. So here you can see additional charges, and I'll just open up the main page so you can actually see that in a bit better detail. So the two charges that we have on this specific purchase order is we have a storage charge and we have a purchase freight charge. Now, against this additional charges table, we can actually specify which document line the charge relates to. So if one of these charges only applied to one of those products, so for example, some warehouses may charge a handling fee for large format bottles. You know, if they're needing to pick a Jeroboam off a pallet, they might charge a slightly higher fee. You are able to assign a specific charge to a specific product and say, I want it to apply to this line on the purchase order. And that way, if you had 10 Jeroboams on your purchase order against one of your lines, that cost would be distributed across those 10 Jeroboams. The other example against here is your purchase freight. So I have a charge of £150, which is currently being applied to all of the components on the purchase order. So what we are seeing is we have the ability here to recognize those costs, apply them to the document, and it's worth bearing in mind that none of these charges will impact what you pay to your vendor, your supplier. Your product cost is going to be taken from the purchase order lines. The value that you pay the supplier comes from those purchase order lines. However, these costs are incorporated by the system into the receipted goods cost. So it's that understanding of your cost of goods is increasing as a result of these charges. You also have the option here to nominate a vendor. So for example, for purchase freight, if you are working with a specific vendor, you're able to nominate that charge against that vendor. So therefore, when it comes to reconciling the invoice for them, you're able to match those up quite easily. And you can also set a currency code. So potentially you're paying, shipping in euros or USD or whatever currency, but you have the option to determine the currency against the additional charge as well. Now, the impact of this is once your goods are receipted, as I mentioned, those costs are distributed across the contents of the purchase order. You do actually have a little bit of flexibility here. So if I open up the distribution costs again, just to show you the setup. Against the table, we have the option here to change the assignment. So we can choose how we assign those costs and whether we want to do it on base quantity, whether we want to distribute it based on volume, weight, or financial value. So you could say, for example, if we were bringing in a mixed pallet and we were saying that we were bringing in, some entry-level wines and some super premium wines at the same point, you'd be able to distribute the charges in weighted favor of the value. So you'd be able to ensure that you're not eating into the margins for those less expensive products, which are probably quite low margin to begin with. Now, as it suggests with the title on the ribbon where it says default additional charges, we are able to build in these charges so that they automatically apply. So you do have the option to add them on each document. So every time you create a purchase order, you've got a quote from your freight haulier and you can say, okay, I've got the quote, I'm going to apply that as an additional charge. And we'll take that as an expected cost until we've actually invoiced and confirmed. But you can actually take this a step further and you can have the system say, we will apply these charges based on the logic that we've assigned here against additional charges. So that is the ability for you to say, I want to set up all of my rate tariffs from my freight haulier in advance when I receive a new rate card at the beginning of the year. And then if you had, potentially packing fees from a supplier, you can, if I drop down the list, I can give some better examples, but you could say that anytime I purchase it from this specific vendor, I want to add in an extra cost because I'm aware of the cost that's associated with that. Country of origin, depending on where the specific product is coming from, if there is a cost that is associated from the import and freight from that specific country, you are able to assign those charges and those costs automatically on documents. Locations is another good one. You may potentially have multiple warehousing partners that you work with, depending on the goods that you're receiving and the sort of the stock turn of those. But based on location, you can also include these charges because the landing fees might be different depending on where the goods are being delivered. So there is a lot of flexibility within this. The best use cases I've seen typically do revolve around the hauliers and kind of setting up rate cards so that when certain goods are purchased from certain locations, there's the ability to add those charges into the purchase order. And then again, it just gives you a truer sense of your cost of goods when you are actually creating purchase orders and receiving stock. Now, the other side, because as I mentioned, half of this is the purchase side where we're looking at not just the cost of our goods, but the costs associated with importing and sort of warehousing our goods. The other side is the sales side. So similarly, we do have the same functionality that extends to a sales order. So if I open up a sales order here, on the right-hand side, you can see some more additional charges. And so if I open up the additional charges table on this sales order, you can see here that I have a sales courier charge. I've included a storage charge, and I've also put an RH&D charge on here as well. So the courier charge does have a vendor associated with it, so you'll be able to reconcile that charge in future. You can also see the same currency code field applies, that if you were looking to apply specific currency to specific costs, you could. Now, it is worth pointing out that the additional charges at this point are cost-based. So these are not charges that are being effectively passed on to a customer at standard. This is something that you are looking at from an internal view, saying this is the cost associated with fulfilling this sales order. And so the result of that is when you are looking at the margin of that specific sales order, you are not only factoring in an accurate goods cost and a cost of goods, you are reporting effectively on the costs associated with fulfillment. And so what I would expect, again, as a good use case for the sales order side of things is typically around the delivery. So if you're given a rate card from your sort of delivery third-party logistics provider, you'd be able to build the rate card into the system. You would be able to automatically populate those costs on sales orders so that you are able to capture that, so that you have a much truer understanding of what your resulting margin is. And bear in mind, this sort of information can really help shape a lot of business decisions as to what couriers you use. Potentially, if you're delivering across the UK, there may be some regions and some areas within the UK that you can find a more economical courier. And so there is flexibility to try and change that. But it's only after you actually really understand the impact that these costs have on your profitability that you can take that data and use it to sort of pull together some business decisions. So to give you an understanding as well on the sales order, we do have little checks in place against here, because as you can see, we do keep track of things like the unit price, which is effectively the price we're charging to the customer, and we do have the unit cost. Now, using those two figures, you're able to determine that there is, margin to be had. So over on the right-hand side of the sales lines, we actually do have fields which can calculate the unit cash margin and the line margin as well. So you're able to just sense check at a sales order level whether you're selling goods at an appropriate price, considering the costs associated. Now, if we were trying to look at something in a little bit more detail, because obviously an open sales order is not a committed it's still an open document. It hasn't actually been posted to the system, so there is still a chance that prices can be adjusted, etc. But if we were wanting to get a better understanding of the profitability and looking at it at a much more kind of regimented and kind of granular level, what we can do is actually refer to the item ledgers. And sort of rule of thumb, I think, whenever it comes to sort of inventory reporting and looking at sort of transactions at an item level or a sales level, the item ledgers are typically one of the best places to look, just because they capture a lot of detail and they have it in a centralized location. So if I filter this page to sales, so let me just quickly apply a couple of filters to make this super relevant. And yeah, okay, that seems to work. Right, so at the moment I filtered the item ledgers to sales shipments, and what we can see here is a record of each item transaction that's occurred as part of a sale. So on this, on the item ledgers, I can see, that it was a sale, it was a sales shipment. I can see the document that it relates to, which is a sales shipment. I can see the item number we're referencing. I can see the description, the duty status. I can see the location that the goods were fulfilled from, the rotation number, and I can see the quantity that went out. Now, there are a couple of other fields. So unit cost is obviously one, but I'll keep scrolling just to show you a few others. So sales amount actual. So this is our actual cost or actual price that we've charged the customer. Our cost amount actual is the costs that are associated with the actual goods themselves. If I continue scrolling across, you've got unit prices. This is the individual price per unit, so per base unit. And then I've got a cost here for cost amount non-inventoriable. So this is where your sales costs feed into the scenario. So if you think about it, sort of taking a step back with what we were discussing earlier, your costs on your purchase, so the point of getting your stock into the system, we are capturing things like freight, insurance, RH&D, etc. That will increase the value of your stock. The cost of your stock increases because we are taking those charges and saying, well, these were costs associated with bringing this product in, therefore the cost of this product is actually greater because we have to factor in these costs. So those costs will sit in your cost amount actuals column, as you can see on the screen. Your cost amount non-inventoriable, that is your sales side. So that is essentially the costs that we've looked at on the sales order, which say we are taking these goods to a customer and there are charges that we need to factor into that. And they're not technically inventory costs, they're secondary. So they sit in a separate column. So that's where we have the cost amount non-inventoriable. And from here, we have our cash margin and our margin percent. So if we ignore the top entry because that was a return, but the next couple of entries down give us a cash margin here of £13.03 and a margin percent of 52.13%. So you can see on the item ledgers that there is a very specific way of being able to determine the profitability of these transactions. Typically speaking, I would say that a lot of people who use Bevica would have filters that they set up and save against the item ledgers where they can run views so they can see all of the entries where potentially the cash margin or the margin percent is less than, it might be 10%. And that way you just have a nice, and again, you can apply date filters to make sure that you're only looking at, the past 3 months, for example. But that would be a really quick way of you being able to scan through and just ensure that, everything is being sold at an appropriate margin. And it would also give you the ability to investigate discrepancies. So if something came through at 3% margin or negative margin, you would understand, well, we've got something not quite right here. So it gives you a bit more focus to be able to actually head into those individual transactions, investigate what the discrepancies are, see where potentially costs are misplaced or revenues misplaced, and be able to take it back from there. So within all of this, there is still some great reporting that's also on offer within Bevica. So item ledgers are a great place to start your reporting. There are a couple of other reports that are worthwhile considering when you're looking at them. But the thing I do want to show just before we head over for question time is if you were to utilize something like Power BI. Power BI is a data visualization tool which allows you to extract data from Bevica. It populates these really, really interactive dashboards, as you see on my screen now, and it imports that back into Bevica so that you're able to navigate those dashboards within the actual solution. So if you have this extension as part of your package, you're able to produce reports that can show things like profitability. So from here, we have the option to put together some and you'll have to obviously forgive some of the data in the test environment. I mean, 222 net profit would be lovely, but probably not achievable. But with the correct data, you'd be able to have a really good breakdown on your actual gross profit on a monthly basis and be able to take a running gross profit as well. And that's just one of the reports that exists within the Power BI suite that we offer with Bevica to show that true granular reporting. Another consideration as well when it comes to reporting is the ability of using dimensions. Now, dimensions are, they're like little tags that you can assign to items, vendors, customers, sales order, purchase orders, and they are categorization tags that flow through the process of kind of creating a document and posting it to and impacting your general ledger. And what that means is with the postings going all the way through to your chart of accounts, you're able to actually filter your chart of accounts based on these dimensions. So if you were wanting to check, costs that were incurred from certain hauliers, like there'd be so many ways of being able to find this information, but you could actually start reporting on things like, from a customer level, saying how profitable is this specific customer when we factor in all the charges of, importing these wines for them and fulfilling the wines to them. So maybe you can see that your freight charges or your sort of delivery charges that you're incurring are disproportionately high compared to the revenues that you're making. And so it's that kind of visibility over your data, which provides a lot of insight to be able to help you make informed decisions. So that was basically running through some of the standard margin reporting in Bevica and Business Central. We do have a couple of minutes left, another 2 minutes left on our time. So if anyone does have a question, please feel free to put it in the chat box, as I'm super happy to run through any of those questions for you. The team would be more than happy to explain any of what we've covered for you today. But thank you again for taking the time to join us. I hope you've learned a thing or two. And like I said, please keep in touch if there's anything further we can help with.